welcome back. So, let us continue from where we left off in the last lecture, but before we do that, a quick recap of where we stand. We have discussed in detail the relationship between debt and equity of a company, and we agreed that we need to have a debt equity mix for optimality or for a minimization of the cost of capital of the company. I would like to emphasize here that this viewpoint is somewhat in divergence with the viewpoint of Miller Modigliani, who in their celebrated capital structure irrelevance theorem propounded that the value of a firm is independent of its capital structure, it is independent of its financing mix. However, this result was arrived at on several very restrictive assumptions, and the operation of the financial markets as perfectly efficient, which incidentally are not realistic in the practical world. Later on, of course, they relaxed some of their assumptions and introduced the concept of the firm deriving value from the interest tax shield that it enjoys, but again certain assumptions therein were also restrictive. So, I will leave it at this and maybe I put a note on this in the appendix to this PPT or in the supplementary notes. Then we moved over to derivatives, and we defined derivatives as securities that derive their value, that derive their worth from the price or the value of some underlying asset, some underlying structure, financial structure. That underlying financial structure could be stocks, it could be indices, could be interest rates, could be commodities, could be bonds and even real estate. I also brought to you the valuation formula for the derivatives as the discounted or the present value of expected future cash flows at maturity arising from the derivative, that expectation being calculated on the basis of risk neutral probabilities. Then we discussed the common types of derivatives: forward contracts, futures contracts, options contracts and swaps. Forwards, as I mentioned, are customized contracts that entail two relevant dates, one relevant date t equal to 0, that is now, that is the point at which the forward is incepted, created, that is the date of negotiation of the contract at which all the terms in relation to the delivery and the unambiguous settlement of the contract are agreed upon, and a future date at which the contract is actually settled by the delivery of the underlying asset and payment of the price as per the conditions agreed upon at t equal to 0. The important thing is that these are customized contracts, and therefore, the parties to the contract have adequate opportunity to assess the creditworthiness of the other party and take measures for their safeguard accordingly. Futures, on the other hand, are contracts where which are traded, which are similar to forwards, but which are traded in organized exchanges. And because futures are traded, or to facilitate the trading of futures uninhibitedly, two things are required which are duly incorporated in futures contracts. Number 1, the contracts are standardized, and number 2, the risk component or the default component, the possibility of default of the counterparty is eliminated. This is done by introducing the clearing house of the exchange as an intermediary between the two legs of the contract. In other words, a single futures contract is split up into two contracts, one between the long party and the clearing house, and the second between the short party and the clearing house. The clearing house guarantees the performance of both the legs of the contract. Now, because the clearing house guarantees both the legs of the performance of both the legs of the contract, it becomes necessary for the clearing house to protect its own interests, and that it does by introducing a scheme of margining and marking to markets. We will again talk about it at a later point in time. Option contracts, on the other hand, are slightly different from futures and forwards in the sense that they have one leg of the option contract has a right attached to it, and the other leg of the option contract has an obligation attached to it. In other words, an option contract is a right whereby one party to the contract has the discretion to buy or sell an asset at a predetermined price at or before a prescribed or a predetermined date. So, it differs from futures and forwards. In futures and forwards, both the parties have obligations to honor their legs of the contract, whereas option contracts give one party a right and the other party has the obligation to perform the contract if the party that has the right decides to exercise the option, decides to exercise his right under the contract. So, that is a significant difference, and of course, because one party is at a superior pedestal, he is enjoying a right, the second party merely has the obligation. Therefore, for this difference in the standing, the long party or the party that has a right has to pay a certain upfront fee to the party that is short, and that fee is called the option premium or the option price. Swaps are exchanges of cash flows or streams of cash flows spread over multiple periods. In a sense, they are a sequence of forward contracts. We shall again talk about this in later point in time. Let us now continue to hybrid instruments. Now, the prototype of an hybrid instrument is the concept of preference shares. So, what are preference shares? Let us read out the definition of preference shares. Preference share capital means, in the case of company limited by shares, I have already explained the concept of limited by shares, whereby the shareholders have limited obligations confined to the amount, the nominal amount of the shares that they have taken up. That part of the capital of the company which, number 1, carries a preferential right to payment of dividend during the lifetime of the company, carries a preferential right, a preemptive right to the payment of dividend during the lifetime of the company, and number 2, carries on the winding up of the company, on the liquidation of the company, a preferential right to be repaid the amount of capital paid up. So, in other words, they, in terms of the return of capital and the payment of dividend, they are at a superior position compared to equity shareholders. They have a preferential right. In fact, that is why they are called preference shares, because they have a preferential right as to the payment of dividend. They must be paid dividend before the dividend to equity shareholders is paid. And number 2, in the event that the company is liquidated, the company is wound up, then on the disposal of the assets of the company, the claims of the preference shareholders must be satisfied first before the claims of the equity shareholders. Now, why preference shares are hybrid instruments? Well, let us talk about them. The debt related features of preference shares are, they normally carry fixed returns, although it is not mandatory, but usually preference shares carry a fixed rate of dividend. Maybe 10%, maybe more, maybe less, but the rate is fixed, and it is computed of course on the basis of face value. Then they have a preemptive right, just like lenders who have a fixed would normally have a fixed rate of interest accruing to them. Similar, and again, just like lenders have a preemptive right to interest and repayment of their lendings, the preference shareholders also have a preemptive right to the payment of their dividend and the repayment of the capital that they have paid thereon on the preference shares in the event of liquidation of the company, and these preferential rights are with respect to the equity shareholders. Then there is another point. Just like the lenders do not have any voting rights in respect of the general resolutions of the company, of course, they do have voting rights in the context of resolutions that directly affect their interests. Similarly, preference shareholders do not have, in general, they do not have voting rights to vote on the resolutions that are of general nature relating to the affairs of the company. However, of course, they have they have voting rights in respect of class meetings where their interests are directly involved. Nevertheless, there is a caveat to this, there is a catch to this, that if that is provided by section 47 of the Companies Act 2013, and that says that in the event that the dividend on preference shareholders is in default for 2 years or more, then the preference shares will also have a voting right on the general resolutions of the company, but in normal situations the preference shareholders have no voting right, just like the lenders of the company. Well, equity related features, now this is very important. How do we distinguish between what is the relationship between equity and preference shares? Well, the most important part is that dividends on preference shareholders is discretionary. It is not a mandatory payment. It is not a charge against the profits like interest. Interest is a charge against the profits. It must be debited to the profit and loss account irrespective of whether the company earns a profit or not. However, dividend on preference shares are discretionary. The company has discretion to declare and pay dividend on the preference shareholders. So, it is not a charge against the profits, it is an appropriation of profits, very much like equity dividend, and therefore, it does not enjoy an interest tax shield. You do not get a tax shield on the dividend payments, just like the equity dividend. So, this is a very important relationship between preference and equity dividend. They are on similar pedestals. Both equity dividend and preference dividends are distribution of profits, are appropriations of profits. They will not be debited to the profit and loss account, but they will be treated as a distribution of profits and taken directly to the statement of changes in equity, and the preference dividend does not enjoy a tax shield like equity dividend. Therefore, keeping or taking cognizance of all the features that I have elucidated so far, we can have the following situations and we cannot have a certain situation. Let us look at this. Both preference and equity dividends are paid, we can very much have this situation. In fact, this is the ideal situation where the company is in profits and the company pays up the preference dividend, and then on the basis of whatever remaining profits are there, the shareholders in general meeting decide to pay equity dividend as well. We can also have a situation where the company is in losses and therefore, the company is not paying up the preference dividend as well as the equity dividend. In other words, dividends on both preference shareholders and equity shareholders share capital is not paid. We can also have this situation if the company is in loss, or even if the company is in profits and the management decides, the shareholders decide not to pay dividend to retain profits for future use in the company for reinvestments, then they can take the decision not to pay both the preference dividend and the equity dividend. We can also have a situation where the preference dividend is paid, the dividend to preference shareholders is paid, but the equity dividend is not paid if the company in general meeting decides to do so. But we cannot have a situation where the preference dividend is not paid, but the equity dividend is paid. This situation is not tenable under the law, under the definition of preference shares. Dividend on equity shareholders can only be paid, dividend on equity shares rather can only be paid if the dividend on preference shares is already paid at the fixed rate envisaged in the contract of issue. Now, why preference shares are not popular? Well, there are certain reasons for this. The first thing is that the preference shares do not carry any voting rights. So, because in normal circumstances preference shareholders do not carry any voting rights, and because the preference shareholders do not carry any voting rights, the company as a whole does not seem to be answerable to the preference shareholders. The policies and the strategies of business to be maintained, initiated and maintained by the company are decided by the company in their general meetings of equity shareholders, not by preference shareholders. So, in that sense, the preference shareholders do not have a say in the affairs of the company and running the company. Then the second thing is that if the company happens to do well, if the company earns profits, then naturally the profits or the benefits of those profits will accrue to the equity shareholders. It may result in capital appreciation or it may result in a high rate of equity and dividend, but the preference shareholders get only their restricted fixed rate of dividend. And if the interest rates increase, well, the lenders tend to gain, and again the preference shareholders are left out of the gains arising out of increase in interest rates. So, in some sense the preference shareholders lose out on both counts, and therefore, the capital appreciation in the context of preference shares is very limited, because the benefits therefrom holding therefrom are very limited. Now, this is the perspective from the of the investor. From the perspective of the company, from the perspective of the issuer company, again preference shareholders are not the very best option, in the sense that if the company raises debt, then it could well get debt at a relatively cheaper rate compared to preference shareholding, because of the level of risk attached to debt being less from the perspective of the investor, because it enjoys a preemptive right over preference shareholders as well. The lenders enjoy a preemptive right over preference shareholders, who enjoy a preemptive right over equity shareholders. So, lenders find themselves in the least risky position, and therefore, they would be willing to lend money at a relatively lower rate. And not only that, we have the benefit of the tax shield operating in favor of lenders, and therefore, the cost of lending could well under normal circumstances be relatively lower than the cost of preference shareholding. Preference shareholders, because the risk profile is greater, is higher than that of the lenders, would require a higher fixed return on their investments, and then again the issue of tax shield does not operate to mitigate or to reduce the cost of preference shareholding, and therefore, preference shareholding does not also find favor with the issuing company. There are different types of preference shares, different varieties of preference shares. We have cumulative and non-cumulative preference shares. We have convertible and non-convertible preference shares, redeemable and irredeemable preference shares, participating and non-participating preference shares, callable and non-callable preference shares. I will quickly run through the features of each of them. In the case of cumulative preference shares, if the dividend on preference shares for a particular year remains unpaid due to inadequacy or otherwise of the profits of the company decides not to pay dividend on preference shares in a particular year, either because it has no profits or it would like to maintain the funds inside the company for reinvestment and maintenance of the assets of the company or upgradation thereof, then that dividend which is in default would be carried forward to the following year. That is the meaning of cumulative preference shares. The default dividend of a particular year is carried forward to the next year, and it would be paid, and it should be paid next year if the company decides to pay dividend. In the case of non-cumulative preference shares, it is the other way around. If the dividend of a particular year is not paid, then that dividend the shareholders lose the right. The preference shareholders lose the right to recover dividend in the next following year. In other words, the arrears of dividend are not carried forward. Preference shares may be convertible into equity shareholders. This is a feature which is normally introduced to enhance the marketability of the preference shares, whereby preference shares are also given a right to convert their shareholding into equity shareholding at a future date and at a price which is either agreed upon upfront, either given in the prospectus of the issue, or the formula for working of the price of conversion, the computation of the price of the conversion is specified in the contract of issue of the preference shares. These are called convertible preference shares. These are convertible into equity shareholders at a future date and on terms which are contained in the issue of the issue document of the preference shares. Then non-convertible are the standard type of preference shares, where they have no conversion rights to equity under any circumstances. So, these are non-convertible preference shares. Then we have redeemable and irredeemable preference shares. In the case of redeemable preference shares, what do we have? The preference shares are issued for a fixed period. Unlike equity shares, which are by nature irredeemable, you cannot redeem equity shares except in the event of winding up of the company. Of course, you can buy back equity shares under certain circumstances, but you cannot redeem equity shares as such. Preference shares on the other hand can be issued with redeemable rights. In other words, the company would be mandated to redeem these shares at the end of a certain period as per the terms mentioned in the issue document. We also can have irredeemable preference shares. I will come back to the issue of irredeemable preference shares in a minute, because they are prohibited for issue in India. Why it is so, we will come back to it. When we have participating and non-participating preference shares, participating preference shares are those shares which carry a right to participate in the profits of the company and on the surplus assets on the winding up of the company after the rights of the preference shares at fixed rate of dividend etc., or the paid of capital as the case may be, are extinguished. In other words, the profits that remain after the payment of preference dividends, the preference shareholders can again participate in those profits which are left over after the the extinguishing of the primary claims of the preference shareholders to preference dividend or preference dividend at a fixed rate. The rest of the profits can be distributed between equity shareholders and preference shareholders. So, that is why they are called participating preference shares, because they participate in the distribution of profits after the payment of dividends to preference shareholders at the fixed rate, and in non-participating shares it is not the case. Callable preference shares, well, callable preference shares are those preference shares in which the company, call means right to buy. So, in which the company, the issuer company has a right to buy back the shares at agreed times and agreed terms as specified in the issue document. Callable means the issuer of the company has a right to buy back the shares from the investors, from the holders of the preference shares at times and on terms that are specified in the documents of issue of the shares. Now, I come back to the point, why irredeemable preference shares are prohibited in India. Well, to understand the reason therefore, we need to go back to the recommendations of the Sachar committee, which was a high powered committee to examine the upgradation of the Companies Act 1956, and the recommendations of the committee took the form of legislation in 1988 under the Companies Amendment Act 1988. Now, this 1988 Amendment Act introduced prohibition against the issue of irredeemable preference shares in India. The reason therefore was that the irredeemable preference shareholders do not provide the investors with an exit route from the company in the case of adverse market conditions, because you cannot sell the preference shares in the market. They do not have a liquid market for the disposal of those shares, and if the company is in an adverse situation, it has accumulated losses or whatever, and the preference dividend is not being paid, the shareholders have no opportunity, no means of exiting from this worthless investment. So, keeping in view the level of literacy of investors in a company at that point in time, it was decided that the issue of irredeemable preference shares should be done away with in our country. Because people would initially be investing in these shares in the hope, in the anticipation of getting an assured stream of dividend, and when the company ends up in a loss, as a loss making unit, the benefits of assured dividend do not materialize, and the shareholders also do not have an opportunity to exit from this investment. So, and the second thing is, on the one hand, they do not have any means of exiting from this investment if the company is in adverse times, is in bad times. They also do not have any right to participate in the voting rights of the company, and it was therefore decided to do away with the issue of irredeemable preference shares. As to the complete abolition of preference shares, this matter was also taken up by the committee, the Sachar committee, and it was decided at the behest of financial institutions that preference shares should continue to be a part of the spectrum of financial products, eligible financial products for issue by the companies on the basis that financial institutions could be the major subscribers to these kind of instruments, and the financial institutions have the benefit of getting fixed rate dividends during the initial stages of the company without imposing the burden of interest thereon. So, in the at the behest of financial institutions, the request of the financial institutions, the preference shares were continued as part of the permissible issue spectrum of securities. However, irredeemable preference shares were disbanded. Now, as to the treatment of preference shares in accounts, well, if the preference shares have a fixed rate of dividend attached to them, which is normally the case, but not always. Usually preference shares have a fixed rate of dividend, and there is a mandatory redemption feature, that is, they are redeemable preference shares, they need to be redeemed at a future date. Then it is maintained by the IFRS, the International Financial Reporting Standards, that such preference shares which carry the fixed rate of dividend and carry a specified redeemable date would be treated at par with the liabilities of the company. They would partake the character of liabilities of the company, and if these features are not present in those shares, then they would partake the character of equity of the company. So, preference shares that have a fixed rate of dividend and that involve a mandatory redemption feature at a future date, they would be recorded and accounted for as part of liabilities of the company, whereas preference shares which do not have these features would be treated as part of equity of the company. Then I have talked about convertible preference shares which are issued by a convertible right into equity shareholders at the end of a specified period, and on terms which are agreed upon upfront in the issue of the issue document of the securities, and either the price is mentioned or the manner of computation of the price on the date of conversion is mentioned. There is a similar we can also have convertible bonds, convertible debentures which have similar features of conversion into equity shareholdings at prescribed prices, at predetermined prices, or in manner which is predetermined. We can have convertible bonds, we can have convertible debentures. We can sometimes what happens is that in order to enhance the marketability of an issue of bonds or preference shares, warrants are attached to those preference shares or bonds, as the case may be. Now, these warrants act as sweeteners. These warrant acts as marketing gimmicks which provide further liquidity, further possibility of the investor buying these instruments in the primary market or the secondary market, as the case may be. The warrants have the specialized feature that they can be traded on their own. First thing is that if they are listed on the exchange for trading, they can be traded on their own in the first instance, and on the second instance an investor who is holding a warrant can get equity shares in the company to which this warrant relates at a price and at a date or before a date which is specified in the issue document. In other words, a warrant is simply a tradable instrument in most cases or a tradable part of the primary security, which may be a debenture, which may be a preference shares, and which entitles the holder to buy equity shares in the issuer company at a price and on or before a particular date as may be specified in the document of issue of the warrants. So, warrants are a special feature, warrants have that special feature of enabling the holder to buy an equity share in the company at a particular point in time or before a particular point in time at a price which is either mentioned explicitly or the manner of computation whereof is mentioned in the issue document. The fixed price or the price at which the warrant may be exercised is called the exercise price, and the date up to which the warrant can be exercised is called the maturity date. Now, there is a subtle difference between warrants and options. As I mentioned, warrant is a right to buy equity shares in the company at the exercise price on or before the expiry date. Options are similar contracts, but the important difference between these two is that while warrants are issued directly by the company in which shares can be taken up by exercise of the warrant, option contracts are released for trading by the exchanges at which they are traded, and they have nothing to do really with the issuer company or the issuer of the underlying stock. So, this is the fundamental difference between warrant and option. Warrants are issued by the company to which they relate. Options are issued by the exchanges in which they are traded, and they do not relate to the underlying the issuer of the underlying in which is to be taken up or which can be taken up by the exercise of the option. So, we take a break now, and after the break we will take up a very interesting and important concept of risk in financial terms and the related concept of arbitrage. Continue after the break. Thank you.